Welcome everyone to our COVID-19 and Your Retirement Workshop. Our goal in this short video presentation is to outline the major changes in response to COVID-19 that affect your retirement planning. Just a couple of quick housekeeping notes. If you have a question, we've got a slide and a time at the end of our presentation to answer those questions. Go down to the chat box, type those in, and then we'll respond to them at the very end. And at the very end also, there'll be some more information. To get more information, links, emails, websites, and then also there will be a link that you can do a survey concerning this webinar here. It's great to have Zoom. We're all learning how to use this, and it's kind of exciting to present this information to you virtually. So again, COVID-19 and your retirement, what has affected your retirement planning? Are you already retired, or are you looking to retire? And so this is what we're looking at. So the last 3 months have been completely devastating. 42 million Americans have applied for unemployment benefit. 42 million Americans, that's like 1 out of 6 workers. The stock market hit bottom March 23rd, nearly wiping out a third of all the value, 36% or so. So it's been a devastating 3 months, the quickest, fastest decline in our economy ever in history, rivaling the Great Depression. It just happened so quick, everything went down. So when things like this happen, our government responds, and they quickly passed a lot of laws, rules, and implement some legislation that does affect your retirement. The CARES Act, the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act, was a very broad and sweeping and had a lot of items in it. The two that will affect your retirement planning are basically listed on the screen there. All required minimum distributions that were due in 2020 have been waived. Now, what does that mean? Well, it means that if you turned 70 and a half last year and you were supposed to take your first required minimum distribution by April 1st of this year, if you didn't take it, it's been waived. It's okay. If you were taking required minimum distributions for the past several years, you don't have to do for 2020. This also applied actually to if you were the beneficiary of an IRA account, of an IRA or a Roth account, then those have been waived also. This includes company plans, TSP, and any retirement account that you were taking a required minimum distribution from. You do not have to take it. You can take it, but you do not have to take it. And there's something in here called the coronavirus-related distribution, which gives you the ability to withdraw up to $100,000 from your IRA or company plans and gives you special tax release. Now, to qualify for this CRD is you had to be affected by the COVID-19. What does that mean? Well, it means that if you were diagnosed with COVID-19, or your spouse or dependents were diagnosed with COVID-19, if you experience an adverse financial consequence as related to the virus, meaning you were quarantined, unable to work, you were furloughed, laid off, or your hours were reduced. If you didn't have child care available, then you can qualify to take money out. Or your business closed, or you owned a business and was not able to open it up because of mandatory shutdowns by governors across the nation. So what's the special tax release? Well, first, if you're under age 59 and a half, normally when you take money out of a retirement plan, there's a 10% early withdrawal penalty. Well, that is waived in this case. Also, the special tax relief is that if you take money out, you can spread the tax on this evenly over the next 3 years, or you can actually repay it back within the next 3 years. So it's letting you basically use your retirement account as an emergency fund. So if you got more questions about that, you can respond a little bit later in the slideshow here. So the CARES Act had a lot of stuff in it, but as related to your retirement and retiring, no RMDs for this year, and you can make withdrawals from your retirement accounts without early withdrawal penalty, and can pay the tax over the next 3 years or pay it back over the next 3 years. Another interesting thing, because the virus hit right and things were shut down right as we're getting prepared to do our normal April 15th tax filing. And so the IRS did notice 2020-18, which extended your tax filing deadline to July 15th. So you have almost another month to basically go in and file those taxes. So what does this mean? It means that if you were a little behind getting your tax stuff together, or were affected by COVID-19 and didn't have time to prepare it, you have till July 15th to file your normal taxes without any penalty, with any late penalties. The interesting thing about this is that you still have July 15th to make any kind of contributions for 2019 to your IRA accounts, your Roth IRA accounts, your health savings accounts, your Archer medical savings accounts, and your Coverdale educational savings accounts. So here you have 6.5 months into this year to make contributions that will help you tax-wise for last year. And then once you make those contributions for 2019, it might be a wise idea to try to start making and getting payments made onto your 2020 contributions. So you have time. Uncle Sam's giving you some relief in filing your taxes for last year. So what's happening now? Here's the day's update. We mentioned earlier that 42 million Americans, basically 1 out of 6 working Americans, filed for unemployment benefits. When they give these reports every week, the number of claims, the total number, you have to go down, way down in the headline and look for what's called continuing claims. Now, what that means is of the 42 million who applied initially, the continuing claims is half. 21 million have gone back to work. That is really good news. They were laid off or furloughed for a week, 2 weeks, 3 weeks, and went back to work or found another job. So when half of this number has gone back to work in a short period of time, that really is relatively good news. Now, make no mistake about it, 21 million Americans being unemployed is staggering, and it affects lives all across the nation. But yet, we're recouping those, and actually, in a previous report, the economy actually added 2.5 million jobs. So the slow turn to getting back to work and getting our economy up and running is happening, but it is a slow turn, and we're very optimistic that this trend will continue. So, all right, Steve, but I see that when I watch the news and read the paper, that the stock market has made big gains. It was up 500 points today. It was down 1,800 points last week. What's happening here? I see the news that the tech companies are making new record highs. Matter of fact, the NASDAQ closed above 10,000 last week. Big companies are soaring. However, they're not fully recovered, and it's very uneven. Thus, the picture that we have here on this slide. What's kind of interesting is that large companies and tech companies have really roared back. The market bottom was on March 23rd, and many companies that are large and technology oriented have zoomed back 40% and are actually year to date up positive, anywhere from 4 to 6%. However, small and mid-sized companies, about 73% of all the companies, are negative for the year and really currently running around 20 to 25% negative. So if you're looking at your portfolio and it's not quite keeping up with the market, it may be because of the diversity you have within your portfolio of small companies, mid-sized companies, non-tech companies, utilities, and things like that. So take a good look at your diversity, where your sectors, where you're invested, and that may make some sense to you why part of it is growing good and part of it's not. Big companies and technology companies have really recovered tremendously. It doesn't mean that the smaller companies and mid-sized companies won't catch up. It just means that, this has been a very uneven recovery. The crash took everything at once, but the turnaround has been very uneven. So you might want to look at that a little closer. So how does all this really affect retirement? Well, in all honesty, the basic rules for looking to retire, or if you're already in retirement, really haven't changed. And they haven't changed because of COVID-19. They didn't change in the market crash of 2008 going to early 2009. It didn't change with the tech bubble, well, with the housing bubble, let's go back to 2007, 2008, the technology bubble that crashed in March of 2000. All of those we have guided clients through. We've lived those, we've experienced them, and the basics stay really the same. What you have to look at is, what is my current monthly spending now when I am working? You've got to have that big B word, a budget. What is my monthly spending? And then if I am not working, what is my income and how much will I spend not working in retirement or even semi-retirement? Some things that you can maybe cut out is you may not eat out as much if you're not working, perhaps. You may not travel as much and not have as much gas and car expenses, perhaps. But you've got to look at basically what your current budget is now, do a forecast of what you may be spending, what your income level is now, what it will be in retirement, and see if you have a positive budget. The biggest drag is debt. Going into retirement or planning to go into retirement with a mortgage is very difficult. A car loan, credit card debt that's being carried over month to month. That is money that's going out, taken away from other income categories. The biggest single thing you can do to help yourself have a comfortable, reliable retirement is to eliminate debt, if at all possible, before you even consider retirement. And the other thing that affects basically when and how you can retire is the size of your nest egg. How much money have you set aside? How much money can you expect from Social Security? There's actually, if you're a married couple, 567 ways to calculate Social Security benefits based upon the age of each husband and wife and the amount that you can receive at age 62 or full retirement age, or at age 70 when you get the stepped up valuations. We run those reports for people all the time and be glad to run one for you. Even if you're a single person, we can run those to show you the differences in dollars and how it affects your income, retirement income, based upon age and timing of when you may take it. The size of your nest egg, how much money can you withdraw safely? How much can I earn and not be getting into my principal? That's where this long time theory called the 4% rule is a very ginger rule of thumb. It's not hard, fast law of retirement. However, it says that you could probably withdraw 4% of your nest egg, 4% a year, and never run out of money in retirement. Now, in today's world, if you're in your early mid-60s, quite honestly, you've got the plan for 30 years in retirement. I call it the third half of life. You know, think back where you were 30 years ago. If you're in your early mid-60s, you could potentially have another whole 30 years to live. And so that's why you've got to be very frugal and to a point, but also make sure that you have a large enough nest egg so that you don't get 15, 20 years out and you start running out of money. That's a sad, sad place to be. Through guidance, we'll be glad to chat with you about some forecasting and planning and budgeting, but that's a very rough rule of thumb. So right now, if you have $500,000 in your retirement portfolio, $20,000 a year, okay, let's say $20,000 a year, and let's say that your Social Security check will be somewhere around $36,000 a year. So you're up to around $56,000 a year. Is that enough for you to live on and do what you want to do in retirement? So the basic rules have not really changed because of COVID-19. What am I spending now? What will I be spending in retirement? And this is a moving target, quite honestly. Do I have a debt now that I can get taken away, that I can pay off? Yes, let's work on that. The size of my nest egg, I know it's taking a hit, Steve, you're right. I took a big loss back in March and April. Some things have come back. I'm not all the way back. I'm not close to 40% up, but yet I've made some improvement. Might need to kind of go to semi-retirement first to let that nest egg grow. And then do a quick rule of thumb of 4%. Add that to your Social Security, any pension income you may have, and that will give you an idea of what your retirement income may look like. Okay, this is a time for any questions that you may have down at the chat box there. Here's one that came in. I did not cover this. It said, okay, what if I've already taken my required minimum distribution for 2020? Remember, this change did not come out till in the February, March. The CARES Act didn't pass till way into March and stuff. And many people took some money out for the required minimum distribution in January, February. Well, there's good news and maybe not so good news. If you took a required minimum distribution out, you can roll it back into your IRA account and as if it never happened. However, you have to do this within 60 days of when you receive the money. So this is June 16th. If you receive the money anytime after April 16th, then you can do what's called a rollover. You can put the money back into your retirement account and it won't be taxable for you for this year. It's just a rollover. However, rollovers are tricky. You can only do one rollover per every 12 months. So you must not have done any IRA to IRA rollover, or Roth IRA to Roth IRA rollover in the past 12 months, or it's going to be taxable. So if you took some money out last year and put it back in, then you got to watch for the 12-month period there. So it is a possibility. You can roll it back in to your IRA account if you've already taken your required minimum distribution for this year. If you were getting a monthly or quarterly check and you don't need the money, you want to keep it, then contact your financial advisor, your custodian who has the money, and tell them to stop or suspend your payments until next January or until a later date that you notify them of that. So if you've taken it out already and it's been within 60 days, you do have the opportunity to put it back and it will not count as tax to you. Okay, another question here is if I don't file my, if I don't file my taxes until July 15th, we are 6.5 months into 2020. How do I estimate what my 2020 taxes will be? Well, that's a great question because actually your 2020 tax planning really should start at January 1st. However, most people wait till they file their taxes in March or about April 15th. We're already 3.5 months into the tax year, and they look at their taxes, what they owed, and start making some adjustments in withholdings and things like that based upon their tax return. We're pretty late in the year, but there are some things you can do. Once you get your 2019 taxes filed and have a return, if you like, we can plug that into the 2020 tax brackets and give you an estimate that if your current withholdings for last year will work and we'll keep you above board for paying taxes 2020, we can run that. We can run a little quick software program just to let you know where you stand tax-wise for this year based upon last year's income. Or if you know that you're going to have a large withdrawal, maybe you did take money out of your IRA account for the coronavirus-related distribution, and you got $30,000 you took out, you're going to count $10,000 that's taxable this year. We can plug that $10,000 into our tax software and tell you what it looks like, how much extra withholdings you may need to have, what your estimated taxes may be. So there's many things to do there, and we'll be glad to respond to those and help you out. If you would like to get more detailed information, personal question you may have about your situation, email us at info@rightlegacy.com, right there on the screen. You can call us at 270-723-0333. Go to our website where there's information there and how to contact us there also. And then we always do by email or hard copy a monthly newsletter. And this past month for June, I did an article about what just happened where I recapped the past 3 months. And I cited 4 lessons that we have learned along the way. If you'd like a copy of that article, just email us. We can email it to you, or if you want a hard copy, we'll put it in regular snail mail for you there. So here's how you contact us. I appreciate your time, and we look forward to doing our next workshop next month, and we'll have more going along the way.